In this video, we will be discussing price action and market cycles. Over the course of this entire masterclass, we have learned many different strategies and indicators for creating success in the world of options, futures, and stock trading. Ultimately, when it comes down to it, indicators and strategies help us build an edge that let us repeatedly see the same signals for entry over and over again to track our progress and build on our success. Over the course of many years and much data collected, the market typically repeats itself in the same cycle over and over again. And even if we lost all of our indicators, we could rely on price action alone to learn to recognize the market cycles that take place on every time frame in every market to help us still trade successfully. These types of market cycles and strategies were created by some of the greats in the world of finance and stock trading. Charles Dow, Richard Wyckoff, and Jim Dalton are some examples of people who have identified the importance of market cycles and the volume associated in the stages of those cycles to make the retail trader successful on the level that is typically only reserved for smart money institutional traders. We will be discussing a series of phases that take place in a market cycle, known as the preliminary stop, the selling or buying climax, the automatic response, the secondary test, a false breakout, a sign of weakness or strength, an upthrust or spring, a breakout, and then the path of least resistance to the previous area of supply or demand. Okay, this is August 31st on ES 30-minute chart. We just have no indicators on the chart except for the volume bars. So we see we're in a downtrend. We're watching this play out, watching volume remain relatively stagnant until this bar where there's a spike in volume. So we're going to make note of it. And at the time, we don't know for sure, but there's a possibility that we refer back to this as the preliminary stop. We see a lowering of volume. And a spike in volume here, which we'll mark note of in case it ends up becoming the selling climax. We see it start to build back again and accumulate near the preliminary stop, and see a large spike, which we'll make note of in case this ends up being the automatic rally. Into the secondary test. So now we're pretty confident in our structure here. Lower volume here in our areas of what we're guessing may be accumulation, as this is order collecting underneath what we now believe to be our preliminary stop and higher than our selling climax. If you look at our volume here, we now have lower volume underneath our original selling climax on what could be called a stop run or a false breakout, when our breakout candle shows the lowest volume at the lowest price for volume divergence. Now that we're back into our area, we believe this to be the spring. And higher volume to the buy side is starting to confirm our suspicions. Volume divergence shaking out at the preliminary stop level. As volume increases at higher prices, all that's left is to challenge the automatic rally level to show the breakout. Now that trend is confirming that this is a breakout, we look for the next area of distribution, which we believe to be our former area of supply. Once we hit our old supply, profit taking, selling, and ultimately the restart of a new cycle. We see we're now starting to form volume divergence as the momentum falls off. And we reach the passive supply, probably also fueled with aggressive selling in the form of market orders to complete the entirety of a cycle on no indicators but volume and price action, using Wyckoff theory and passive supply to understand how smart money moves through the market while shaking out retail buyers. So as you can see, we have relatively consistent volume right through basically months of price action until these candles here. So it's this spike in volume that piques my interest with these wicks and the double top that tells me this may be an area where smart money is beginning to accumulate a position for a move back up. That would be called the preliminary stop. It's not quite the bottom. This is just sort of where they're starting to amass their position. The next phase would be the climax, which you could also use candle structure and volume to help you identify this area by these double bottoms here. And you know that it's the climax if it's followed by the automatic rally, which is a sharp response up that overtakes even the preliminary stop. This will now be the boundary of our range, wherein this 100 points of price action will be where institutional traders, for example, will be building their position. And from the looks of it, you may already be able to tell that somewhere around here is where they're really having a good time creating their cost basis for this position. It's important to note the phases and this secondary retest here, which for a lot of you guys, our intraday use is enough for you to enter the position because it adds more confirmation to the phases that we've already put in place. It also lets you know that maybe it's not time to go full position yet, depending on your time frame, your capital, because you know that there's still going to be some moving and shaking, possibly that's outside of the boundaries of the ability of your port to withstand. A good way to tell that's taking place is by these false breakouts here, which is another look below even the selling climax and the secondary test. And you can use little hints in here to also tell you that this may be a false breakout. For example, the breaking candles, let's call them wide range bearish candles, are extremely low volume compared to surrounding candles. And there are also the wicks in response of the reversal type candles, and again, low volume on the breaking candles, letting you know that this false breakout could potentially be leading to the spring. The breakout is not totally confirmed until it challenges again the highs set by the automatic rally. So even getting back to preliminary stop here, smart money has no problem shaking out longs, retail longs that think they're slick, especially since we can look back and see that inventory is telling us that even their shakeout is still above their cost basis. A nice good look here on this high volume buy candle with the wick here that's responsive to our inventory. It's actually kind of interesting and funny that the gap happens right at the automatic rally, because this is also something that's called a gap and trap, which just immediately traps all the shorts into this position as they cycle up pretty much uncontested and through the path of least resistance up into the previous supply. But even if it was not a gap, the breakout of this level and the trend that follows shows you that the breakout is set, the trend is building, and its path of least resistance up to former areas of supply is is likely where the price is headed. So if we're looking at this giant, 2-week 100-point range of price action, and you're thinking, oh yeah, Kala, that's really cool, but some of us aren't even allowed to swing on our accounts. Well, that's fine. We can look at this down on intraday, and then within intraday we could look at it down on a 5-minute chart, and within a 5-minute chart we could look at it on a 1-minute chart. So we're looking at this whole move with the preliminary stop, the selling climax, the automatic rally, the secondary retest, the false breakout in spring to breakout up to former supply, and we start to see what's so interesting about these areas where we have this little accumulation. It looks like a little shrunken down version of that entire picture that you just showed us. Well, that's by design. It happens. Money and the volume of money that's traded through this market every day is not allowed to sit and wait on the sidelines while this is happening. There can be guys sitting 2 desks away from each other that are playing positions inside of someone else's positions, and then a guy down the hall is playing positions bigger than both of their positions combined, and so on and so forth, inside and outside. And we see basically that the whole thing is just still happening again. We come down and we start to slow the rally, have this wick, and see that maybe this is a preliminary stop where these levels are starting to form here. Whoops, this is the wrong line, but it'll work for right now. We come down and set a selling climax, followed by an automatic rally, wherein we have one last false breakout, look below and fail, where we make higher highs and higher lows, ultimately leading us to believe that we're about to test the level of the automatic rally again, and have confirmation on the breakout showing higher volume than the other wide-ranging candles. So although these are still 2 giant candles, we'll see that even still the breakout is confirmed by the highest volume. So we move all the way up into a breakout. So this little section here is a whole other iteration of the entire stack of phases that we just talked about in the big time frame. And now I'll zoom out to show you how that price action is happening inside of this whole picture. So through that whole thing from August 31st to September 13th or 14th, there's a whole other iteration of this phase taking place literally the day it starts to the following day. So really it's just an intraday iteration of this phase happening right here. And what makes this so exciting, but also to add context to your game. You might think you're slick. Sometimes I think of like a school of fish, not even realizing that they had been swallowed by a whale until they've been digested, because it seems like they're in an entire whole chunk of ocean just inside of the mouth of a blue whale. So it's important to kind of always be thinking of this stuff inside and outside, backwards and forwards, and make your plays accordingly.